Welcome to the Opening Bell Report.
Okay, picture this. It is February 11th, 2026.
A Wednesday.
A totally normal Wednesday. You're sipping your morning coffee, you open up your portfolio, expecting, I don't know, pretty standard stuff.
Just another day in the markets.
You scroll down past the high flyers to the bedrock, the boring, reliable companies you never really worry about, and then you see it. S&P Global, ticker SPGI.
And it has just fallen off a cliff.
Not just a little stumble either. We're talking nearly 10% in a single day.
It was a proper crash. For a company that's supposed to move like an ocean liner, it suddenly started trading like some volatile crypto coin.
It hit a fresh 52-week low, $401.08.
Which, for a company this size, is just, it's a massive amount of shareholder value being erased in hours. It's the kind of move that makes you spill that coffee.
It really is. And that's exactly what we're digging into today. We've got a stack of analysis reports in front of us, earnings transcripts, charts, and our mission is to answer one very specific and very expensive question.
Is the business actually broken?
Or is this a classic case of the market just panicking and, throwing the baby out with the bathwater?
It's the classic falling knife dilemma. Do you try and catch it, or do you let it hit the floor? The analysis we're looking at today argues this is a rare valuation reset.
A reset.
Yeah, the argument is that this crash has basically handed investors a chance to buy a monopoly asset at a discount we just haven't seen in years.
I do love a good contrarian take, but I have to be the skeptic here. A stock like S&P Global doesn't just drop 10% for no reason. There has to be a fire somewhere.
Oh, for sure.
So let's start at the crime scene. What was the trigger? I'm looking at the Q4 earnings report here, and correct me if I'm wrong, they missed their earnings per share by 2 cents.
That's right. 2 pennies.
2. So they reported adjusted earnings of $4.30, and the street wanted $4.32. You're telling me the market shaved off billions in value over 2 pennies?
I know. It sounds like insanity.
It feels like a glitch in the system.
And if it were just about the pennies, you'd be right. It would be a glitch. But you have to remember, markets are forward-looking. They don't really care what happened last quarter.
They care about next year.
They care about what's coming next. That earnings miss, that was just the appetizer. The main course, the thing that really gave investors heartburn, that was the guidance.
The outlook for 2026.
Exactly. The consensus on Wall Street, what all the analysts were modeling, was for earnings of roughly $20 a share next year. I think the exact number was $19.96.
Okay, so almost 20 bucks. That was the bar.
That was the bar. But then management gets on the call and basically says, hold on, folks. We're actually looking at something more in the range of $19.40 to $19.65.
So a guidance cut. But let's pause on the math here. They're cutting expectations by, maybe 3 or 4% at the high end?
Roughly, yeah.
So here's where I'm struggling. Why does a 3% haircut on future earnings lead to a 10% decapitation of the stock price today? The math it doesn't add up for me.
That is absolutely the right question. And it gets to the very heart of stock valuation. To understand why the drop was so violent, you have to look at how SPGI was priced before the drop.
Okay.
This stock was wearing a designer suit. It was trading at a huge premium multiple over 32 times earnings.
32 times. Wow. That's what you'd expect from a high-growth tech company, right? Not necessarily financial infrastructure.
Or a company that's seen as perfect. When you pay 32 times earnings, you're pricing in double-digit growth year after year with no hiccups. You're paying for a Ferrari. But then, in their guidance, they forecast organic revenue growth of only 6 to 8%.
Single digits.
Single digits. And that's the friction point. That's where it all grinds to a halt. You cannot trade at a hyper-growth multiple while delivering mature compounder growth. The math just breaks.
So the market saw that 6% growth and basically said, wait a second, you're not a Ferrari anymore, you're a Lexus.
A very nice Lexus. But a Lexus nonetheless. And a Lexus doesn't sell for a Ferrari price. The multiple, the price people will pay for each dollar of earnings, it just collapsed instantly.
A repricing event.
Textbook. The business didn't stop making money. The market just decided to pay a lot less for that income stream.
Okay, so the price tag got swapped. But the analysis report we have here argues that this repricing went way too far, that the pendulum swung from overpriced straight past fair and deep into bargain territory. How cheap are we talking?
Well, let's take that new lower guidance. If we use the midpoint, call it $19.53 a share, and we use the new stock price, around $401. The forward PE ratio is compressed all the way down to about 20.5 times.
From over 32 down to 20. That is a massive compression.
It's huge. And the report notes that if you exclude the absolute peak panic of the 2022 bear market, this is one of the lowest valuations we've seen for S&P Global in 5 years.
But I have to push back a little. Is 20 times earnings really cheap? I mean, the S&P 500 average is often around 18 or 20. So isn't SPGI just average now? Why get excited about paying 20 times for a 6% grower? It sounds fair, not like a steal.
Because context is everything. You can't just compare it to an average stock. You have to compare it to its peers.
And in this industry,
there's only one real peer, You can't talk about S&P Global without talking about Moody's,
The Coke and Pepsi of credit ratings.
the famous duopoly. And usually, these two stocks are joined at the hip. Same business model, same regulatory environment. And historically, they traded almost the exact same multiple.
So how is Moody's looking right now? Did they crash too?
And that's the kicker. They didn't. Moody's, ticker MCO, is still trading around 35 times earnings.
Wait, seriously, so Moody's is still at the party in the expensive suit, and S&P Global just got sent to the clearance bin.
That is the dislocation the report is highlighting. A massive gap has opened up, a 15-point spread in the multiple. If you believe, as the market has for decades, that these are fundamentally similar assets, well, buying one at 20 times versus the other at 35 times is a huge opportunity.
Okay, but that begs the question, right? Is the market seeing something we aren't? Is there something structurally wrong with S&P that justifies it being so much cheaper? Maybe they're losing market share or something.
That's the fear, that there's a ghost in the machine. But the data doesn't seem to support that. In fact, the report argues the business quality is as high as it's ever been.
The moat is still intact?
The moat is fully intact. This divergence seems to be purely about this temporary guidance shock, not a fundamental breakdown of the engine.
Let's define that moat, because I think when people hear S&P, they just think of bond ratings. Some guys deciding if a company is AAA or junk. But it's so much bigger than that, isn't it?
Oh, much bigger. And its durability comes from how it makes money. S&P is what you'd call a capital-light compounder. They don't need factories or raw materials. Their product is data and opinion and trust.
Which means high margins.
Astronomical margins. The report highlights a metric called free cash flow conversion. This is arguably the most important number for a mature company.
Okay, so what is that?
It's a simple question. For every dollar of revenue that comes in the door, how much of it ends up as cold, hard cash in the bank that they can actually spend?
And for SPGI?
It's around 37%.
So 37 cents of every dollar is pure free cash.
Yep. And to put that in perspective, compared to other financial data giants like LSEG or FactSet, great businesses, but S&P is superior to almost all of them in converting sales into cash.
Okay, but again, playing the cynic, why should I, the listener, care about that? Does that cash actually help me as a shareholder, or does it just sit there?
It absolutely helps, especially when the stock crashes. This is the beauty of it. When you have that much cash and your stock price suddenly drops 10%, what does management do?
They can go out and buy their own shares.
Aggressively.
Yeah.
It's a self-correcting mechanism. The lower the stock goes, the more shares they can retire with that same pile of cash.
Which boosts earnings per share for everyone who's left.
Exactly. It puts a natural floor under the stock price.
Yeah.
It's like the company itself is saying, if you don't want these shares at $400, fine, we'll take them.
Let's go back to the business model, because you mentioned the bond ratings. That's the volatile part, right? Companies only pay for ratings when they're issuing new debt.
Correct. It's cyclical. If interest rates spike, that business can dry up pretty fast.
Which seems risky.
It is risky. But S&P has spent the last decade building what the report calls a revenue shield to offset that. They have their market intelligence division, and even more importantly, the indices division.
The S&P 500.
The S&P 500, the Dow Jones. They own the intellectual property. Think about the explosion in passive investing. All the ETFs, the mutual funds, 401ks.
Wait, so let me get this straight. Every time I buy an S&P 500 ETF, like SPY, S&P Global gets a cut.
A licensing fee. It's a toll road. They don't have to manage the fund or pick the stocks. They just own the name S&P 500. And as long as assets under management in those funds keep growing, whether from market returns or new savings,
They get paid.
they get paid. It's an incredible business model. It provides this steady, subscription-like revenue that buffers the volatility from the ratings business.
The report called it owning the language of finance.
I love that phrase.
Yeah.
Because it's true. You can't really operate in the global markets without using their ratings, their data, or their indices.
So fundamentally, we have a dominant business that prints cash, has a recurring revenue safety net, and it's trading at a huge discount to its only real competitor.
That's the bull case in a nutshell.
But there's always a but. We have to look at the chart, because fundamentally a stock can be cheap, but technically it can still be a disaster. And this chart looks like a waterfall right now.
It's ugly, I won't lie. Catching a falling knife is dangerous. And the report acknowledges the technical damage. It broke all the trend lines. It scared away momentum traders. But that also triggers signals for the contrarians.
So what are we looking for in the wreckage?
First thing is the RSI, the Relative Strength Index. It's basically a speedometer for price. Right now, it has almost certainly plunged below 30.
Which is the magic number for oversold.
In theory, yes.
Well,
It suggests the selling pressure is reaching an exhaustion point, but oversold can always get more oversold, right? You need a floor, a price where buyers actually show up.
a support level.
And the analysis points to a critical zone between $390 and $400.
We're hovering right at $401 now, so we're testing that floor right now.
We are. And that level is both psychological, round numbers, and structural from past price action. But the warning is clear. If it breaks $390 with conviction, there isn't much support until you get down to around $350.
So there's still real downside risk here. This is not a guaranteed bounce.
There's no such thing. But there's also a magnet overhead, something called a gap fill.
Okay, explain that. What's a gap fill?
When the stock crashed overnight, it fell from around $440 straight down to $401.1. On the chart, that leaves a literal empty space, a gap where no trading happened.
A vacuum.
A vacuum. Yeah. And markets hate a vacuum. Technical traders see these gaps as magnets. The theory is that once the panic subsides, the price will naturally try to rally back up to fill that gap, to test that 418 part $200 and $420 level again.
So there's a potential medium-term trade there, but the report's verdict wasn't about a quick trade, was it?
No, not at all. The verdict was strong BY, but they used a very specific word, accumulate.
Accumulate. That implies patience.
It implies buying in pieces. Don't go all in at the market open. This strategy is to pick up shares in this $395 to $405 zone. But, and this is the part people miss, the timeline is key. This is a 12 to 18-month play.
And they warned about dead money.
Yes. They explicitly said to expect the stock to be dead money for at least a quarter.
Meaning it might just do nothing.
It might just drift sideways. It could be boring. The market needs time to digest this new reality. The big institutions need to rerun their models. You're probably not going to see a V-shaped recovery next week.
And that's hard for people. We want that instant gratification. Buy the dip. See green tomorrow.
If you want that, go to the casino. This is investing. You're buying a piece of an incredible asset, tucking it away, and letting the cash flow and the buybacks do the work over the next year.
Before we wrap, we have to talk about the elephant in the room. What breaks this thesis? What's the nightmare scenario where this thing goes to $300 and just stays there?
It's one word. Rates.
Interest rates.
Always interest rates. It comes back to that ratings business. S&P gets paid when companies issue debt.
And companies issue debt when rates are low. It's cheap money.
Exactly. But if inflation spikes again, if the Fed has to get more aggressive and hike rates further,
the borrowing stops.
Issuance volume freezes. CFOs just sit on their hands. And if that happens, that high margin ratings revenue dries up, and that 6% growth guidance they just gave
could turn into zero or negative.
And then management has to come out and cut guidance again. That is the single biggest risk. You're making an implicit bet that the bond market is going to stabilize.
So if you think inflation is coming back with a vengeance, this may not be the trade for you.
Correct. Stability is what S&P needs.
Okay, so let's bring it all together. A massive market overreaction to a moderate guidance cut. A company that basically owns the financial operating system, and it's now trading at a huge discount to its twin brother, Moody's.
That's the story. It's a rare chance to buy a monopoly asset, but you have to have the stomach to wait out the boredom and the panic.
Which brings me to a final thought for you to chew on. We spend so much time in the market obsessing over growth. Is it growing at 20%? Is it the next big thing? But maybe we overlook the power of just certainty.
The reliable architect versus the flashy rock star.
Exactly. S&P is the architect. It's not going to double next month. But if a company is generating that much cash, buying back its own stock, does it really matter if the top line is growing at 6% instead of 12%?
The math of compounding says no. At 20 times earnings with that kind of cash flow, you can build massive wealth over time.
So maybe the boring compounding phase is actually where the real wealth is built, provided, of course, you have the patience to ignore the noise and let the machine do its work. Thanks for listening.
Don't forget to like, share, and subscribe for more.